Well, Annalise, thank you very much for that expansive and rather daunting introduction. And my thanks to the Clarke Program for inviting me here today. It's a particular pleasure for me to follow Frank Upham. I met Frank when we were both sent out to East Asia as Luce scholars in the hope that someday a year's work in Asia would shape our future careers. That was almost 40 years ago. It hurts me to say that, but it was almost 40 years ago. And it still reminds me of the endless personal and professional pleasure that I've had in working on East Asia. Which reminds me, I have a very soft voice, so I'm going to be counting on all of you against the wall in the back to wave your hands if my voice drops off. The Treasury, like all finance ministries, is problem and crisis driven. But as a policy advisor, I've always found great satisfaction in working with economies that do well. And the post-war growth of the East Asian economies is one of the great transformations in international economic history. As Larry Summers put it, it's on par with the Renaissance or the Industrial Revolution. As an economist, I like to measure things in people's incomes. And 2 generations ago, per capita incomes in much of developing Asia were on par with Africa. In 1960, Singapore and Hong Kong had about the same per capita income as Algeria. Today, Singapore is comparable to Belgium and Hong Kong to Spain or Italy. In 1960, Korea had about the same per capita income as Morocco, and today it's comparable to Portugal. Since 1980, per capita incomes in emerging Asia have risen 6-fold, lifting hundreds of millions of people from poverty and elevating many to middle income standards of living. East Asian economies now account for almost 30% of the global economy and have accounted for 35% of global growth over the past decade. The US economy is now heavily oriented towards the Asia Pacific. 30% of US trade is with East Asian economies, 60% with the Asia Pacific region. The Obama administration, from its very beginning, recognized the strategic, political, and economic importance of Asia to the United States, as well as the importance to Asia of continued US engagement in the region. Although perhaps less apparent than the political and strategic reorientation of Asia, towards Asia, the central importance of the region in US international economic policy is also clear. What I'd like to do is describe several key priorities of US economic policy and then describe why those policies are important to East Asia as it addresses the risks of maintaining growth in the future. The fundamental US priority is to increase employment and income opportunities for Americans in our engagement with the region. That's Trade Policy 101. It's probably International Relations 101. The administration, the US government has worked hard to increase market access and level the competitive playing field for US firms and workers in the region. The administration has focused its trade negotiating strategy on East Asia, first with the Korea-US Free Trade Agreement, and now we're negotiating the Trans-Pacific Partnership with 10 of our most important trading partners. The TPP is a 21st century trade agreement that I'll have a fair amount to say about a bit later. Our economic relationship with China, which takes up much of my time, presents enormous opportunities as well as many challenges. The economic track of the President's strategic and economic dialogue with China, led by Secretary Geithner of the Treasury and Vice Premier Wang Qishan of China, is the most visible part of an intense and extensive engagement that we have with the Chinese government to get China to open up its markets, protect intellectual property and trade secrets, reduce the competitive advantages of state-owned enterprises, and move towards greater exchange rate flexibility. So the first priority is clearly American interest, increasing opportunities and incomes for Americans in the region. The second priority of US policy is to support strong growth in the region and in the global economy by establishing a more balanced and sustainable pattern of growth in China and in other large external surplus economies, many of them in East Asia. This involves a shift or rebalancing towards greater reliance on domestic demand rather than exports for growth. It is important both to support strong and sustained growth and to avoid the reemergence of large current account imbalances that contributed to the global economic crisis in the recent past. The last priority that I want to mention is U.S. support for an open, inclusive, and rules-based global economic and financial architecture, one that reflects the current importance of East Asian and other rapidly growing emerging markets in the global economy, and one in which they are full participants. This is reflected in our efforts over the last 4 years to reform the governance of the IMF and the World Bank, and to increase the representation of East Asian and other rapidly growing emerging markets in those institutions, what we affectionately refer to as Treasury as the shares and chairs exercise. It's also reflected in the negotiation of a new set of disciplines on official export finance, now going on with China, Brazil, India, and other major providers of official export credit. These priorities reflect U.S. interests and the U.S. role in the world, but they also reflect the interests and indeed the needs of East Asian economies as they work to sustain growth and achieve high income status. The colloquium this year has been about risks, and it's to risks I'd now like to turn. These risks are not apparent, particularly if you look at relative performance over the last few years. So this is real GDP of the major advanced economies, the US, the Euro, and Japan, since the first quarter of 2007. If you superimpose East Asia over that, you get this. The East Asian economies have shown remarkable resilience after both the Asian financial crisis and the global financial crisis, and it's a brave man who bets against East Asian policymakers. But despite their past successes, East Asian economies face real challenges and risks in sustaining growth in the future. These flow out of the factors that have led to their past success, as well as their current importance in the global economy. There's an extensive literature in economics on the East Asian miracle, and many factors were involved. But in every case that I can remember, it was a shift of orientation towards promoting exports, with a reduction in trade barriers, the avoidance of overvalued exchange rates, plus macroeconomic policies that encouraged saving and investment that led to an acceleration of growth. Export orientation allowed East Asian economies to make use of abundant supplies of unskilled but low-wage labor, raising employment and incomes. But it also narrowly focused the attention of entrepreneurs and businessmen on quality improvement, cost reduction, and productivity growth. Selling into a global competitive market, there was no possibility for monopoly positions, no special licenses or privilege, and thus minimal possibility for corruption or rent-seeking. But at the same time, export orientation also created a distinction between a competitive, efficient traded goods sector on the one hand and domestic sectors, particularly services, that remain more heavily regulated, more monopolized, and much less competitive. The dichotomy between export and domestic industries was sharpened by the unbundling of manufacturing production and the growth of global supply chains that started in East Asia in the 1990s, which led to large volume, specialized component production destined almost entirely for a global chain. 3 observations can give you a sense of the difficulties of the domestic sector. The Asian financial crisis exposed the weakness that came to be termed as crony capitalism in many East Asian economies. Corporate control is highly concentrated in several East Asian countries. Corporate control, A recent study, actually a 1999 study by Claussens, Jonkov, and Lang, found that large families controlled over half of East Asian companies, found that large families controlled more than half of corporations in the East Asian countries outside of Japan. 10 families controlled more than half of stock market capitalization in Indonesia, the Philippines, and Thailand, and over a third in Hong Kong and Korea. Over 16% of total market capitalization is controlled by one family in both the Philippines and Indonesia. Companies that are dominant in their markets, especially in established industries, are rarely competitive. And the domestic sector, the ownership, the lack of competition, I think is an obstacle to innovation in domestic industries in many East Asian economies. The weaknesses are particularly acute in the service sector, which is often heavily regulated with strict limitations on entry, innovation, and consequently on productivity growth. A notable example is Japan, where slow and declining growth of productivity in the service sector has been a substantial constraint on Japanese income. Now, I use productivity growth and per capita income growth almost interchangeably because they're essentially the same thing. If you look back over the last 30 years, productivity growth in Japanese manufacturing has remained essentially unchanged at about 4% per year. But productivity growth in the services sector fell from about 3.5% per year in the late 70s to less than 1% per year from 1999 to 2004. The slowdown in service sector productivity growth alone in Japan lowered total productivity growth, essentially total per capita income growth in Japan, from just under 4% to 2% per year in the same period. The third example that I'll use is the financial sector. East Asian nations took steps to strengthen their financial systems after the Asian financial crisis, but they still remain weak and underdeveloped relative to many emerging markets, including many markets in Latin America. Asian financial systems are still bank-dominated, despite efforts to develop domestic bond markets. They're still heavily oriented towards industrial borrowers and property loans, and in several cases oriented to large state-owned enterprises. The lack of an institutional investor base means that Asians export safe capital in the form of the buildup of very large foreign exchange reserves and import risk capital from global investors willing to bear risk. What this means is that changes in global risk sentiment, as we've seen recently, lead to big outflows and inflows into relatively small Asian financial markets, large financial disruptions, and huge pressure on exchange rates. These characteristics wouldn't matter if East Asia could depend in the future on the same factors that drove growth in the past. But unfortunately, they cannot, although this fact was masked by events leading up to the global financial crisis. At this point, I need to turn to a little U.S. economic history. The near decade from 2000 to 2007 was a very good one for the global economy and for East Asia in particular, and much of the reason had to do with U.S. consumers. Household income is driven, household consumption expenditure is driven primarily by income, but wealth also matters. And in the United States, household wealth is typically 4.5 to 5.5 times household disposable income. But the boom in stock market prices and house prices pushed the ratio of household wealth to income up to 6.3 times during the middle of the last decade. Wealthier U.S. households spent more. The U.S. savings rate fell. Household consumption grew at 0.5% per year faster than U.S. GDP, which is huge in macroeconomic terms. U.S. imports surged, and our current account deficit rose to reach 6.5% of our GDP by the end of 2005. The counterpart to large U.S. deficits was large current account surpluses elsewhere in the world. In China, the current account surplus exceeded 10% of China's GDP in 2007, and surpluses also rose in many other East Asian emerging markets. When the crisis came and housing and stock market prices plunged, U.S. household wealth fell by about $12 trillion, or about a fifth. Saving rates immediately rose, and the brake on consumption that this involved was one of the primary causes for the recession in the United States. U.S. households are rebuilding their finances. The U.S. housing market is adjusting, but the recovery from the deepest post-war U.S. recession is still disappointingly slow. In Europe, internal imbalances and overborrowing by countries in the periphery has led to a sovereign debt and banking crisis in Europe. European output is now falling, and the eventual recovery in Europe is going to take years. If advanced economy spending is going to be restrained for some time, who will provide the sources of demand growth that will power global growth in the future? That is in essence the challenge that the G20 has been wrestling with since the crisis. This is the global rebalancing issue, how to shift aggregate demand growth towards rapidly growing external surplus economies, and how to assure that once the global recovery takes place, large external imbalances that might endanger future growth don't reemerge. Although East Asian economies are in effect being asked to support global growth, their interests in rebalancing are clear. The first interest is in the difference between a robust global growth of the type that we've had in the last decade or a low global growth equilibrium constraining incomes worldwide. The second interest is to reduce the vulnerability that East Asian economies have to external recessions. For, despite all the talk of decoupling, East Asian dependence on advanced economy growth remains very high. To get a sense of this, this is a chart of, it's essentially the responsiveness of growth in several East Asian economies to a 1% recession in China, Europe, and the United States. And you can see for several of the economies, Malaysia, Singapore, and Thailand, the elasticity or the responsiveness is more than 1-to-1. And the dependence on the US and EU are still quite high. Finally, there's the issue of size. Small countries can grow by increasing their share of the global market, but large countries or whole regions cannot continue to depend on increasing market share. For at some point, they are the market. China is already the world's largest exporter, and East Asia accounts for 30% of global exports already. While the rebalancing of growth is necessary for East Asian economies, it also has its challenges. For Southeast Asia, or for Northeast Asia, this is primarily a matter of raising the share of consumption in GDP by raising household incomes, boosting household confidence by strengthening the social safety net, and also by unlocking the savings tied up in corporations, both private and public, in the region through increased dividend payments. For Southeast Asia, the emphasis, at least in the short term, is likely to be on increasing investment, both in capital equipment and in infrastructure to support growth. Rebalancing also requires a shift from the export and import competing traded goods sectors towards a greater role for domestically focused industries, particularly services like construction, finance, healthcare, and others. For many countries in the region, this means a shift from highly efficient, agile export industries towards more sheltered, regulated, monopolistic, and frankly lethargic domestic-only sectors. This is a shift of emphasis only. It's not a binary choice, but it does increase the difficulty of maintaining rapid productivity and income growth. Increasing the dynamism of the domestic economy requires deregulation, usually sector by sector, to allow increased competition, entry of new firms, and the introduction of new products and services. Now, any structural change like this creates losers as well as winners, spurring the opposition of vested interests. The incumbents in sheltered domestic industries are often powerful forces against deregulation and market opening. In addition, making the internal shift of resources away from traded goods sectors and towards domestic industries involves an increase in price of non-traded domestic goods relative to the prices of traded goods, exports and import competing goods, or more precisely, an appreciation of the real exchange rate. Exporting firms and firms in import competing industries can be counted on to oppose exchange rate appreciation, and in fact, they do strongly. So rebalancing, the first challenge, while necessary, will neither be easy nor difficult for the East Asian economies. The second challenge that I want to talk about, one related to the first, is what's known as the middle income trap. Many developing countries have gone through initial industrialization and income growth, often through increased trade, that has taken them to middle income status, but the step to higher income has often proved to be much more difficult. The definition of middle income is admittedly vague, but using the World Bank definitions of per capita incomes between about $1,000 and $12,500, of the 101 economies that achieved middle income status in 1960, only 13 had achieved higher income status by 2011. Several of the ascending economies were East Asian, Singapore, Hong Kong, and Korea and Taiwan, but many countries, including many in ASEAN, appear to be caught in a middle income trap. Initially, low-income countries can develop by producing unskilled labor-intensive products, using low-wage labor and imported technology. The transfer of labor out of low-productivity occupations, particularly agriculture, supports this process, adding to income and output growth. But as countries reach middle income status, the pool of transferable labor begins to dry up, wages begin to rise, and the opportunities for technology transfer begin to dwindle. To escape the middle income trap, countries must upgrade skills, move into higher value-added industries, and develop new products and technologies domestically. Empirical work by Barry Eichengreen at Berkeley shows a clear tendency for per capita income growth rates to fall, and in fact fall substantially from 5.6% per year to 2.1% per year in his sample, as countries reach a medium income level of about 15,000 US dollars per year. He finds growth slowdowns most likely in countries with persistent high investment rates and chronically undervalued exchange rates. While raising investment is a boon to initial growth, persistently high investment rates often indicate resource-intensive growth sustained by investment with increasingly diminished returns. Undervalued exchange rates prolong the dependence on low value-added, labor-intensive industries, slowing the move towards more technological sophistication. Both of these factors scream China. China invests almost half of what it produces, the highest ratio that I've ever seen in my career, and one that has increased substantially over the past decade. And the renminbi has been undervalued for years. The dangers in China are also made worse by a demographic transition that will rapidly age what is still a rather poor country. China's labor force will peak in the middle of this decade, and the non-agricultural labor force will probably hit a peak about the end of the decade. Chinese authorities are well aware of the middle income challenge and technological upgrading and the development of domestic innovative capacity are a clear priority of the Chinese government. Malaysia is a continuing interest of mine and one of the most ambitious initiatives to escape the middle income trap is Prime Minister Najib's new economic model for Malaysia. This plan focuses on strengthening university education and research and development capacity, and also on developing a more competitive domestic and business environment, including by reducing the role of state-owned enterprises and by shifting government support measures from ethnic-based to need-based measures. The plan, of course, is very controversial in Malaysia, but the stakes for that country are huge. So the second challenge, one of escaping the middle income trap and moving into higher income, more technologically sophisticated occupations and activities. Finally, I want to talk a bit about the institutional infrastructure of the region and the U.S. role in it. More than any other region of the world, East Asia has seen intensive, almost feverish efforts to build regional organizations, regional, often overlapping institutions. ASEAN, the 10-member Association of Southeast Asian Nations, is at the center of many of these efforts, and ASEAN centrality is a key force to be reckoned with in the region. Much of the impulse for regional organizations came from the Asian financial crisis, an event that still casts a long shadow over the region. It's really an experience to listen to the Malaysian Central Bank Governor Zeti, describe the harrowing experience of trying to defend the currency during that period. She actually tightens up and begins to shake as she speaks about it. And no image, I think, better captures the humiliation of this experience for Asia than this one. Of the signing of Indonesia's letter of intent with the IMF. In my world, this is the most famous photograph in East Asia. Part of East Asia's response to the Asian financial crisis was to address the vulnerabilities in the financial sector and the corporate sector that led to the crisis. But the countries also set out to run balance of payments surpluses and build up foreign exchange reserves as a shield against future crises. And East Asian reserves now exceed $5 trillion, more than half the global total. The crisis also spurred efforts to build regional organizations to reduce dependence on external markets and the IMF. The centerpiece of this was the Chiang Mai Initiative, a collection of bilateral dollar swap lines between ASEAN countries and Japan, Korea, and China, what came to be known as the +3. The ASEAN +3 organization has become an important regional force in financial reform, in macroeconomic surveillance, and also in trade. Integrating ASEAN domestic markets has long been a goal of that organization. Many agreements have been signed, including with each of the +3 economies, but with numerous and significant exceptions for sensitive industries. Non-tariff barriers have remained largely untouched, and there has been essentially no liberalization of services industries. By 2010, there were 159 free trade agreements, either in negotiation, proposed, or already signed, involving ASEAN countries, many of them overlapping and internally inconsistent in coverage. In the trade world, in a contemporary replay of Marco Polo, who brought pasta back to Europe, East Asia brought the spaghetti bowl of free trade agreements to the WTO. In comparison, probably the most controversial part of my talk, in comparison, the Trans-Pacific Partnership, now under negotiation, is strikingly different. as are the FTAs that the United States has already negotiated with Australia, Singapore, and Korea. The TPP actually began with a P4 agreement among Brunei, Chile, New Zealand, and Singapore. It was at Singapore's insistence and encouragement that the United States joined the negotiations for a Trans-Pacific Partnership, negotiations which Australia, Peru, Vietnam, Malaysia, and then Canada and Mexico later joined. In contrast to other trade agreements in the region, the TPP negotiations have three notable characteristics. First, the agreement being negotiated is comprehensive, is a comprehensive, high-quality agreement that eliminates tariff and non-tariff barriers with very few carefully negotiated exceptions. It opens up services industries, including financial services, and it also includes investment. Second, the TPP is a 21st century agreement. Let me explain what that means. It addresses a variety of behind-the-border issues that affect business and trade. It aims to promote regulatory convergence, unify standards, promote transparency, and eliminate redundancies in licensing and certification in order to reduce transaction costs and promote seamless trade among the parties. It will have strong protections of intellectual property, and it addresses new issues including internet privacy, the free flow of information, and the trade distorting effects of state-owned enterprises. Finally, the TPP is explicitly open to new members willing to sign on to the high-quality disciplines of the agreement. The ambition is frankly that the TPP will become the platform for economic integration in the Asia-Pacific region. The fourth of my three characteristics is that the negotiations are hard. There have been 14 negotiating rounds, and tough issues still remain outstanding. This raises the question of why East Asian nations participate in the TPP negotiations and why so many nations outside the negotiation, despite their criticisms of the TPP, quietly express interests and questions about joining the negotiations. There are, I think, two reasons. The first is the economic value of the agreement to the countries involved and also the countries outside the agreement. The United States remains hugely important to the region as a driver of final demand that drives production throughout the chain, throughout East Asia. And in a world of global supply chains and just-in-time delivery, there's a huge advantage to having the chain, or as much of the chain as possible, inside a single economic area with standard rules, classifications, regulations, and very little, if any, transactions costs like tariffs. But the second reason, I think the most interesting reason, is that the attractiveness and the hard disciplines of the TPP are a tremendous spur to domestic growth in the participating countries. The negotiations cover many of the issues that I've mentioned as issues that East Asian nations need to address to continue and support growth in the future. This is reminiscent, I think, of China's use of WTO accession in the 1990s as a way of driving domestic economic reform forward. And my sense, my assessment is that TPP participation by Malaysia was a clear and carefully chosen complement to the new economic model, a way of forcing through external pressure and external attractiveness the kind of reforms that the Prime Minister wished to achieve. And I think much of the internal debate in Japan on whether or not to apply for TPP entry is concerned with both the difficulty of joining the agreement, but also the spur to long-needed reforms and deregulations in many Japanese sectors. Now, I should be clear that Trans-Pacific Partnership is not a panacea. It won't address all the issues that East Asian nations face. But external pressure like this, I think, is an important spur to domestic reform of the kind necessary to support growth. So in conclusion, I think there are four of four things that I'd like you to take away. The first is that future growth in East Asia is not a given. As the financial types say, past performance is no indication of future returns. East Asia faces real challenges in continuing growth and achieving higher income status. The second is that in order to succeed, East Asian countries need to grow in a way that's different from the way that they've grown in the past. Growth will have to depend more on domestic industries, more on services, more on the industries that have been sheltered in the past. And in addition, growth will have to be more technologically based, rely more heavily on smaller, more nimble, more entrepreneurial, and more technologically innovative firms. I think the third thing that I'd like you to take away from this talk is that domestic efforts at reform in East Asian nations may not be sufficient, and regional-only efforts surely will not be. It may well take an external spur. I've argued in favor of the TPP, but there will certainly be continuing pressure for reform from the US and from other advanced countries to try to make the market opening, deregulation, trade enhancing measures that are in fact necessary for reform and continued growth in East Asian markets. And finally, and fourth of my fourth, the United States has a huge economic interest in East Asia, a huge and continuing interest, and the United States remains vital to growth in the region. Thank you very much. Sure.
Maybe I'll just start off by asking you about ASEAN. So you mentioned that it is, quote, a key force to be reckoned with. And you started off your speech by telling us that as a representative of the U.S. government, of course, you have to put U.S. interests first. And so you're not speaking as a professor, you're speaking as someone who has a dog in this fight. So can you talk a little bit about the relationship between ASEAN integration efforts and the TPP? Are these alternatives to one another? Are they competing projects? Why would anybody choose one over the other? Why does the U.S. prefer TPP to ASEAN?
Okay, well, as often happens, I was caught by a rhetorical flourish. ASEAN centrality is central to the members' approach to international activities and international negotiation. It doesn't mean it's determinative, but there's a clear preference to try to operate as a group, as a larger bulk, in dealing with the major powers in the region, Japan, China, and the United States, as well as the global economy. I've struggled for many years to try to figure out how to approach East Asian nations. And the best I can come up with is a combination of bilateral engagement and ASEAN recognition and ASEAN engagement. But frankly, there are limits to what's there in ASEAN as an organization. I outlined the approach that the United States is taking, which is a high standards, very limited exception, very deep liberalization of trade and business through the TPP. That is, and negotiating only with the countries that are willing to accept that negotiation and those kind of disciplines. That's a quite different approach than has been the case in East Asian countries. When the members of the East Asia Summit, which are ASEAN, Japan, Korea, China, Australia, New Zealand, India, which together form the ASEAN plus 6, as well as the United States and Russia meet in November. At the end of the meeting, the ASEAN plus 6, without Russia and without the United States, will announce the beginning of a negotiation of a comprehensive economic framework agreement. This is an agreement that starts out by including all of the members of the ASEAN plus 6, so 16 in total, negotiating whatever they can agree on. The members are set, the ambition is not. Strikingly different from the way that the US approaches the region. I think that's a huge difference, and I think it's one that matters for the region, which is why I've been reluctant to embrace universal membership, ASEAN in total, rather than a more selective and higher quality, higher standard approach to the region. But it's a big issue. It's a big issue in the region.
Yes, I think you partially answered this question just now, but I'm still interested in, you used the word pressure that the United States could exert in order to get some of these agreements. I wonder if you could elaborate on what pressure tactics or negotiation tactics.
Well, we don't break arms and kneecaps, but we, I mean, we have continuing engagement, bilateral, multilateral, in negotiations, in international organizations, to try to push an agenda forward. It's an agenda that reflects US interests, but it is a global agenda. And in fact, I'm quite proud of the role that the United States has played in building an open economic and financial architecture in the post-war world. We push in communiques, we push in negotiations, we raise issues as they appear. We also take complaints and try to do what we can do to address them from our trading partners, from our partners in the region. I think anyone who has gathered the attention of U.S. economic officials appreciates the extent to which they're pretty relentless and I hope persuasive. But we do try to argue that it's both in their interest as well as in ours. Right.
And increase the domestic consumption,
Right.
particularly in China. And you're talking about institutional reforms, free trade agreements.
Right.
But isn't it, I see somewhat a disconnect because it's sort of like a cultural question. A cultural question. My understanding, savings rates, particularly in China, is what I've read, upwards of 20%. And I don't see how these institutional reforms will necessarily translate into cultural change to increase domestic consumption.
Yep. It won't surprise you, as an economist, I'm not a big believer in cultural explanations. I think they do have a role. I don't think it's very large. China illustrates this well. Chinese household consumption is extraordinarily low by international comparison. Consumption to GDP in China is about half what it is in India, and a bit further less than in the United States. Chinese household income is also extraordinarily low by international comparison. And the extraordinary fact of recent Chinese economic history is the gradual decline of the share of household income in total national income. Let me talk about households first, and then I'll go back to income. Household spending is constrained both by household income and by the fragility of life for households in China. There's a very thin social safety net. Even with health insurance, Chinese families have to pay in advance for medical treatment. There are few opportunities to finance major expenditures in life, even investment expenditures like education. And as a result, Chinese households tend to save in advance, both for major expenditures and to insure themselves against calamity or misfortune. Chinese household income, well, Chinese households save a lot, but in fact they're not the largest savers in China. Chinese corporations are, or Chinese enterprises are, both private but particularly public. The reforms of the state-owned enterprises basically freed these institutions to make money. And many of them are extraordinarily profitable, particularly those in monopolistic sectors. To an approximation, Chinese state-owned enterprises don't pay dividends. And when they do pay dividends, they pay it to the state asset administrative body, which uses the funds to fund investment in, not surprisingly, the state-owned sector. So for China, and I think to some extent for Korea and Japan as well, it's really a matter of unlocking income, shifting it from the enterprise sector to the household sector, and also increasing the confidence of Chinese households to spend. The last observation that I'll make, because I can't resist, is that Chinese who emigrate to the United States very quickly adopt US consumption patterns. And I suspect that with the income and opportunities that Americans' households have, Chinese households would behave, not completely similarly, but very similarly.
I'm a political scientist, so
Yeah.
my question is, do you foresee a role of China in TPP? And do you think there is a role that China can play? And then, as you just mentioned, that the regional FTA arrangement without the United States in Asia Pacific probably will not do for the regional prosperity. But likewise, a regional arrangement without China, I don't think will also serve the purpose. So what's the role of China in TPP? And a follow-up question is that I posed this question to somebody else, but and then they talked about also Vietnam.
Right.
Vietnam is taking part in this negotiation process, and then if China is not ready for the standards and quality, and then what about Vietnam?
Yep. No, it's an excellent question. We have been criticized by China and by others for excluding China and excluding others from the TPP. That's not true. And there was never a decision to exclude any party. Basically, the TPP developed from the ground up among countries that were willing to pursue this kind of a negotiation. We are quite explicit, as are the other members of the TPP negotiations, that this should be an open agreement, open to other countries joining in the future. And in fact, it should be the basis of a free trade agreement for the Pacific, which means that it would have to include China to qualify. Now, you are right in saying that the negotiation poses difficulties for China. It certainly poses difficulties for Vietnam. Those difficulties are expressed in the negotiation, but Vietnam is in the mix and China is not yet. I think maybe the best answer I can give is that the TPP is designed to be what the negotiating members think China and other countries in the region ought to be and ought to be able to do. And in that sense, it excludes no one.
You talked about the tendency for Asian economies to export safe
Yep.
capital and import risk capital, and I was wondering if you could speak to the historical and economic reasons for that, and also
Yep.
how they've responded to this economic crisis in terms of that.
Yep.
In terms of that.
Sure. Go back to that. So, risk capital and safe capital. It's a good question. I'm not sure that I have a complete answer. The two things that strike me. First, after the Asian financial crisis, there were deliberate efforts to rebuild foreign exchange reserves, to run a balance payment surplus, build up reserves which countries pretty much always invest in very safe, very liquid assets like US Treasuries and other major country government securities. So in part that was going to happen regardless, at least in the initial years after the crisis. But the second reason I think goes to the institutional characteristics of the financial markets in many of these countries. The fact that financial institutions outside of banks are not well developed. There's not an extensive, well-regulated corporate bond market. The stock market in many of these countries is viewed as a casino where countries make, or where individuals make occasional bets hoping for quick returns. There's lots of turnover, lots of movement into and out of the market. Countries really haven't developed yet an institutional investor base. You think insurance companies, pension funds that provide long-term investments based on expected future returns, like are so prevalent in the United States and in many other advanced economies. So what's happening is that there's no large, stable source of domestic investment for risky assets like stocks and bonds. And that's provided by foreigners, by global portfolio investors, who have moved into domestic currency investments in very large amounts since the Asian financial crisis, absorbing the risk. But it's also, as Rudy Dornbusch, a former professor of mine, once mentioned, it's money that enters the country, but it's sitting in the parking lot with the engine running. And when signs of risk and increasing global risk aversion takes place, the money moves out again. A larger institutional investor base, I think, would do much to stabilize the financial markets of many emerging countries, not simply East Asian countries, and make them sort of balance the trade in risk and safe capital.
There were a couple of points that you mentioned as you introduced the TPP.
Oh, I'm sorry. Can I stop you for a second? Because there's one more thing that I wanted to mention. And that is, this graph is very dramatic. And it's one point that I take the opportunity to raise. In the United States and in the Euro area, the crisis was largely a financial crisis. And one of the things that we've discovered again is that recessions that start in financial crises are often very difficult to work through and take a lot of time recovering from. For East Asia, at least East Asia outside of Japan, the global crisis was a trade crisis. It was a sharp fall in demand for their exports that recovered fairly quickly once growth stabilized in the industrial world and began to recover. One of the extraordinary things about the past crisis, and in sharp contrast to the Great Depression, or the period leading up to the Great Depression, is that the countries in the G20 cooperated and responded collectively and very aggressively to the financial crisis. There were very large stimulus packages in China, in much of Southeast Asia, in Singapore, which has always been extraordinarily fiscally conservative. And as a combination of the trade rebound and these large stimulus packages, you had a very sharp increase, very sharp recovery from the global financial crisis. And by the end of 2010, many economies were facing overheating and domestic inflation pressures. So this chart's more dramatic than, in fact, the actual situation is. I'm sorry.
So there were a couple of points that you raised when you introduced the TPP that
Yes.
I was wondering if you could expand on.
Yeah.
And the first is that you mentioned that the United States joined in the discussions at the behest of Singapore.
Right.
And I wonder if you see Singapore's request as being representative of all the members that were already involved,
Okay.
or whether Singapore has specific interest in approaching the United States. And the second was that you had indicated that there are some parties who have criticized the TPP but are nonetheless interested in finding out more about it or possibly engaging at some level. And I wonder if we could have a who and what attached to that.
Okay, well, the first one is easy, the second one's harder. The P4 developed into the TPP, and the United States joined at the encouragement of Singapore. They were quite active in getting the United States to make an announcement at the time of the APEC meetings in Singapore. In this regard, Singapore was not similar. In fact, it's quite different from the other ASEAN countries. Not surprisingly, because it's very small, very open, dependent on lack of regulation, lack of barriers, low trade barriers, and international trade. And in fact, it was the frustration of Singapore with the slow pace of economic integration in ASEAN that led Singapore to begin to pursue external free trade agreements, including the bilateral agreement between Singapore and the United States. On the second question, China has publicly criticized the TPP for its exclusiveness. We get questions from China, certainly much interest from China. As for the others, if you were to take the ASEAN countries that are not among the negotiating parties, or at least the ASEAN 6, Philippines, Indonesia, Thailand, probably wouldn't be far wrong.
Okay, last question.
I was just wondering, one of the things you mentioned at the beginning is you'd like to see exchange rate flexibility
Yep.
for these East Asian countries. Does that become difficult to sort of request if the Fed is pursuing the sort of policies which it's pursuing now, which tend to devalue the US dollar? And many Asian countries have seen that as sort of like a competitive devaluation in its own right. I guess a related question to that is do you see there being a source of tension related to the monetization of US debt by the Fed, considering that these East Asian countries hold the majority of these securities?
It would be a good point if it were true, but it's not. And through a succession of quantitative easing episodes, in fact, the US real exchange rate is very similar to where it was in 2007. The Fed's action, like country's monetary policies were aimed at the Fed's dual mandates of maximum employment consistent with price stability. The risk China and other holders of U.S. Treasury securities face are twofold. First risk is that inflation would increase in the United States, reducing the real value of the nominal claims. In fact, inflation in the United States is below 2%. Inflationary expectations are very low. And as Chairman Bernanke said in the last news conference, we've had a far better record on price stability than we have on maintaining maximal employment in the past few years. Furthermore, the United States, the Fed, absolutely committed to maintaining the fundamentals of the U.S. economy and low inflation. The second risk that countries face is that they purchase foreign assets with they maintain undervalued exchange rates, intervene to maintain those undervalued exchange rates, accumulate large foreign asset holdings as a result, and when the ultimate appreciation of their exchange rates take place, the domestic currency value of those asset holdings diminishes. That's not something we can insure against. I mean, that is a consequence of the domestic policy choices. And I think Paul Volcker put it most bluntly, and I think most eloquently, which was, they chose the policies, the intervention policies. We didn't ask them to make those choices.